So I'm going to introduce Erin Wilbur. She's from Washington State, and she is my sister from another set of parents. Um, but her dad is who I call my dad. So Erin, you want to take it away? I'll give you screen sharing privileges here. Oops.
Thank you. All right. I'll share my screen. I'll start that here in a second. But yeah, just thank you for the nice introduction, Katrina or Kat. That'll be hard for me to call you Kat, but you're Katrina to me. So yes, I have been a CPA for going on about, goodness sakes, 25 years. Can't believe it, but it's true. I work primarily in the tax space, but consulting is, these days where I spend most of my time. So helping my clients understand how to structure their businesses to save taxes, to pass their businesses on through the generations and save estate taxes, and just generally get them in a good place going forward so that they're feeling comfortable and confident and don't have to worry about all this tax stuff. That's my job. So yeah, in Wenatchee, Washington, so smack dab in the heart of Washington State. And we have a really unusually high percentage of real estate agents here. So I find myself working with folks like you a lot. I can tell you're all, very seasoned and experienced professionals. So some of the stuff I'm going to go over, I'll probably go over pretty quickly. Because you are probably going to already know, but for maybe some of the folks later that watch the recording that are a little bit newer into the profession, it will still be helpful. So I'll see if I can pull this off and share my screen. I'm going to have to move Katrina, so you're going to be on there for a second.
Actually, it says I have it set up so it should just share speaker.
Okay. Do you guys see Katrina's face? Or just the PowerPoint?
I see you. I see your face and the PowerPoint.
Okay. Let me do this. So do you see my face like right in the middle?
No, it's off to the side. That's the way I set it up.
Okay, good.
It's recording,
all right. Okay,
it's recording
good. Then
from
we're
my
in good
computer.
Shape. Yep. Yeah. I just didn't want to be covering it up. So nope. We're just going to talk about some basics today, but I think that the Q&A at the end is going to be probably, hopefully, where we'll spend a good amount of time, because I'm sure you ladies all have some great questions for me. Let me get this going here. So this is just a little bit about the firm that I'm pretty far from Washington State. So I'm not going to spend any time here, but if you want to refer back to it, you absolutely can. We have 5 different offices throughout Pacific Northwest and Central Washington. Agribusiness, and small business, small to medium-sized businesses where we tend to focus most of our efforts and time. So you've heard a little bit about me. We're going to talk about the basics here and then dive deeper with Q&A, as long as that format sounds good to everybody. We'll talk a little bit about just some red flags, things to be careful of from a tax standpoint. There's a distinction I wanted to make sure everybody knew about, and a structuring opportunity with respect to S corporations. When we get there, if you guys are all already maybe in that structure, let me know and I'll just talk through it maybe a little bit differently than I had planned, and then some specific deductions and then Q&A. So here we go. You all are in the profession that I'm sure you probably maybe already know this, or your CPAs have told you this. Not to say that you shouldn't go after all the deductions that you can, because you absolutely should. But the IRS every year comes out with like the 12 most common red flag audit triggers. Folks in real estate are lucky enough to trip 6 of the 12 with the things that typically show up on their tax return. So just so that you all know, there's a potential and a likelihood for a higher degree of scrutiny on tax returns for folks in your profession, just simply because of the way that IRS algorithms and data, works in the background. So the 6 things that show up for you all: making too much money, which in this case is ridiculously really not very much. $100,000 of gross on a Schedule C is a trigger for the IRS to take a closer look at you. Excessive Schedule C deductions, so just in relation to your income is what that means, and that's pretty arbitrary. Regularly showing a loss. So hopefully this isn't the case, but the market is cyclical and it goes up and it goes down. And there's just a general rule that you all should probably be aware of. It's not to say that you can't show a loss over and over and over again, because a lot of people are in industries or phases of their industry where they just don't make money every year, and that's business. We don't like to see that repeat year after year, but the IRS is going to presume that you are in business to make money versus something more like a hobby if you are showing a profit in 3 out of every 5 years. So if you get to that point where you're not showing a profit, like a bottom line net income, in at least 3 out of 5 years, just be prepared, in case there's questions that the IRS would ask. Still deduct all of your deductions regularly, like you normally would, because you definitely are in business, but you'll just want to make sure that you're being more careful to keep good records if you see a trend like that occur. Like I said, hopefully that won't be the case. You've got meals, travel, and entertainment, all those things that the IRS loves to try to poke holes in. So those would be especially important to document in your records, just in the case that you were wanted to look closer at by the IRS. Home office deduction is another audit trigger item. And then if you were to claim 100% business use of your vehicle, that's another audit trigger item. So 6 of the 12 currently known red flags you guys probably see show up regularly on your tax returns. So it's just a good thing to be aware of and make sure that you're keeping really great records. Kind of back to best practices. So speaking of keeping good records, best practices that I always like to suggest to all of my clients, especially those in real estate. And some of these are hard but especially important because you all are so busy, and a lot of folks in real estate, it's not their only job. They're doing other things as well. Sorry about that. We're very close to a fire station, so that might happen again. I highly, highly, highly suggest to everybody that I work with, really regardless of their business, but especially in small businesses, sole proprietorships, please get a separate bank account. It's going to make your life so much easier. At the end of the year, you basically just have all of your accounting right there in your bank account. So it's easier to pull together information for your accountant. If the IRS does want to look at your tax return and you were to get audited, you only have to provide them information for that bank account. You don't have to put the whole keys to the kingdom of all of your other personal transactions in front of them. And you don't have to try to explain why this is income and this isn't income. So it makes your life a lot easier. You kind of just have a built-in mechanism of record keeping there as well. I know we're all in different states, and so I'm not going to talk too much about the second point, liability protection or utilizing maybe an entity like an LLC to accomplish that. That's really more of a legal matter than a tax matter. But if you have an LLC, then one of the things that I talk about later, which is making an S election for tax purposes, will be possible. And also it does, I think in almost every state, provide you just an additional layer of liability protection between all of your personal assets and whatever is happening in your business. And there's not a lot of real estate that comes, a lot of liability that comes along with being a real estate professional. But you're driving a lot, you're showing homes to people. Things could potentially happen that isn't covered by the insurance that you get through your agency. Maybe even just considering umbrella insurance also, because of all that driving, would be a smart idea. So just be thinking about that, and then tracking your expenses throughout the year. I do it myself, so I'm going to just throw myself under the bus. I'll get to the end of the year and then I'll have to spend like a week of my life that I'm never going to get back pulling everything together for my tax return. And that's just, like I'm working on my Schedule A, that's no big deal. When you're trying to cobble together your entire year's worth of expenses and, all of your records to support those expenses, that's just a pain, kind of torturous to do to yourself once at the end of the year. So there are there's a lot of technology out there, and more that's coming out all the time to help you track your expenses as you go. On this slide, kind of going from the bottom to the top, if you have somewhat of a accounting mind and are interested in keeping track of your expenses very closely, QBO, QuickBooks Online, is very nice feature for when you don't have employees, and it's a pretty relatively simple business structure. They've got them now that it's mobile based. There's a lot of like scan and populate technology. There's you can pull information straight in from your bank accounts. You don't have to do data entry. So if that's not something you've looked at, I would maybe encourage it. But definitely some of these other items towards the top that can help you keep track of your mileage, keep track of your receipts or scan them right at the time versus having to keep, a section of your purse full of receipts all the time and then try to remember what they were for. There's a lot of technology out there that can help you. So this is just a few of the things that we have seen work well for clients that we have worked with. Okay. Katrina, did you want to do any questions along the way? I see like one thing that has popped up in the chat, or do you want to wait and take those all at the end?
No, go ahead. If you can see the chat, go ahead and address the questions as they come up.
Okay, let's see. Oh, okay. It was a comment.
Oh, yeah, the girl
Thanks,
who was
Lisa.
sick.
Yeah.
Yeah.
Okay. So yeah, Lisa has an S-Corp, so that's awesome.
Oh, okay, cool.
Okay.
I have an LLC,
Okay.
which we just did for the ranch. And I was just going to put everything under it as it's each individual S-Corp, I think is how I was understanding it. So KatWilliamsHomes would be its own, and then Williams 3 Cross Ranch would be its own. I think we did the LLC as Williams 3 Cross or something like that. I can't remember.
Okay. So like one LLC that then would have these different activities within it. Yeah. Okay. So let's dive into that. So maybe just by show of hands, if you guys can do that, how many of you already do have S corporations in addition to Lisa? Anybody else? Or else head shakes is fine. Okay. So an S corporation is usually, not always, usually something, it's always something to think about for sole proprietors, Schedule C business owners. It is usually something that will be helpful and save you a decent amount of tax over the course of your professional career. So the reason that real estate professionals and other Schedule C business owners who are, making a profit, the reason they get hit so hard with taxes is they pay, the federal tax, possibly a state tax, and then also self-employment tax. But because you are your own employer and employee as the sole proprietor, you pay both halves. So you pay twice as much self-employment tax as you would if you were somebody else's employee, because the employer pays half, the employee pays half. So it's a big chunk of an additional layer of tax that the S corporation structure can really help to minimize, if you find yourself in the right situation where it works into your favor. And I'll go through a quick little, very, very simplistic example later on. But basically, what you think about is if you've got no legal structure, so you have a business license, you know, you're in whatever state and whatever city you're working in, you've done what you need to do to legally be able to work there, but you don't have an LLC, you don't have a corporation, you don't have a legal entity. You're a sole proprietor, and you're going to do what probably most of you are used to doing: report a Schedule C on your 1040, pay self-employment tax on the net income. If you've got an LLC and you're the only owner and you haven't made an S election, so an election to be taxed differently, the IRS still views the LLC as a disregarded entity, so they completely ignore it for tax purposes, and you still are filing a Schedule C and paying SE tax. If you have an LLC, so you do have to have a legal entity in order to make an S election, but you can make an election to be taxed as an S corporation, and it's a tax-only election, so it does not affect your legal form. You're still an LLC, legally speaking. You don't all of a sudden become a corporation, but you are making an election with the IRS to be taxed as an S corporation, S meaning small. So you have to have under 100 shareholders, and you have to have all U.S. owners, foreign owners are allowed. Trusts are not allowed to be owners of S corporations unless you've made special elections there too. And estates are not allowed to be owners of S corporations for longer than a 2 or so year period of time after an individual has passed away. So there's a few exemptions from being allowed to be an S corporation, but usually that does not apply to folks like you. So normally it works. And the reason it works is because then all of a sudden your S corporation becomes your employer. You're still the employee. But the SE, so then like your employer, your S corporation pays you a reasonable wage. So you receive a wage from your S corporation, and only the wage is subject to self-employment tax. The rest of it is a tax-free, could be a tax-free distribution of profits. So I know that's a lot of words. And so just in general, high level, the benefits of an S corporation is you save that 15% or so of taxes on a potentially significant chunk of your income, depending on what your net income is. The cost of the S corporation is additional complexity. And if you don't already have a CPA, you probably will want one if you've got a S corporation and an S election in place. So just very, very, very simple, high level example. I apologize for the numbers. I couldn't resist. But you kind of have to see it to understand what I'm saying. So let's just say we've got a Schedule C taxpayer who has a $100,000 net income. So income minus expenses, you net down to $100,000. And that would, on a Schedule C, be subject to that 15.3% self-employment tax. So ignoring everything else, that means that at the end of the day, you have $84,700 of profits that you get to keep in your bank, the profits minus the tax that needs to go to the IRS. If you instead were to have an S corporation structure, and assuming $50,000 was considered to be a reasonable salary, it might be less, It might need to be more. I'll touch on that a little bit more in a second. But assuming that that's the number that's determined to be a reasonable salary for you, then only that 50,000 gets hit with the payroll tax. You're still the employee and the employer on those 50,000. So you're paying the 15%, but just on half as much. You're probably going to have to pay a tax professional to help you with your tax returns. So there's some tax preparation fees, maybe also to help you with the payroll aspect of it, doing quarterlies, W-2 at the end of the year, and whatever you have to do at your state level for payroll compliance. But at the end of the day, you have 6,000 or so additional dollars that you can keep in your bank account, keep for yourself, because you've minimized the self-employment tax. And you can still take the other $50,000 of profit out and spend it and use it in the form of shareholder distributions or draws, but you don't pay the self-employment tax on that chunk. So we don't recommend the S corporation structure if if this math doesn't work, or if whatever that number is, 6,000 in this case, if that number isn't significant enough to, in your mind, kind of justify the additional complexity, then it might not be a good idea. But, this is a pretty, I've seen S corporation tax benefits far exceed this. For many people, it does. And you think about that benefit times, 10 years, 20 years, however many years you're going to be doing this gig, that could be, a decent amount of tax savings over time. Reasonable salary is not defined by the IRS. Thank you, IRS. It's one of those things where they've left it very murky, which is good and bad. It's good because as long as you feel good about what you're paying yourself and feel like it's justifiable, then there's not a bright line test, and that gives you flexibility. It's bad because there's not a bright line test, and so it's always open to interpretation, and somebody might interpret the same facts differently than you do. But basically what it should mean is the same thing that you would pay someone else to do what you're doing. And oftentimes what we have determined kind of as a firm, and I think this is pretty common, is for real estate professionals, you can justify that reasonable salary to oftentimes be pretty low. There's a couple of reasons for that. The commissions are not guaranteed, so that's not necessarily what your wage would be. And so if you're thinking about, what you would pay someone to kind of go out there and, beat the street, so to speak, and get the customers, but maybe taking the profit aspect of that off the table, because that's like a bonus, versus your salary. So you can sometimes get to a level of comfort where you feel like that salary portion can be justified to be pretty low, especially if it's not your full-time job. So, you wouldn't want to pay yourself less than minimum wage, because that's probably not reasonable. And you, I'm sure, want to earn a little bit more than that because of, experience and years in the industry of doing what you're doing. But, you can also back off on the annual salary if you're not looking at a 40-hour a week, full-time amount of hours and time going into the job. So it's going to be different for everybody. And so there's, I can't say like, 30,000 would be a reasonable salary, but I have seen reasonable salaries come in that low, just depending on all of those facts and circumstances specific to the individual. So there's some opportunities there. I would definitely suggest talking to your CPA about it if it's not something that you already have discussed, or if it's something that you think would work well for you. Okay. I'm going to hit on a couple tax deductions. Just in addition to, and there's a lot of words here, I'm not going to go over them all, but just to make sure you guys are taking advantage of the good ones, the big ones. There's all the other ones that we can go over too. Or if you have any specific questions after the fact, I'm happy to talk through some of the ones that you might be curious about. For example, pets or something along those lines. But Katrina touched on the vehicle. So that's the first one listed here. You're always going to want to think about at the point when you get a new vehicle, what do I want to do? Do I want to do mileage, or do I want to write off the vehicle? You get the chance to do one or the other, and you can flip-flop back and forth in some instances. So do standard mileage one year and actual costs the next year, but you can't if you have taken an accelerated form of depreciation. So that would be like writing off all of the cost of the vehicle or a significant amount of the cost of the vehicle in the year of purchase. So in a lot of cases, you're going to be married to either mileage or actual costs, which includes depreciation for the life of that vehicle or however long you're using it. So the mileage rate is pretty good right now. So in 2024, if you drive 10,000 business miles, you're going to get basically a $6,500 tax deduction. But if you buy a $50,000 car in 2024, you could potentially get a $60,000 tax deduction in 2024, because there are two rules or two, deduction avenues that the IRS gives us for vehicles. Section 179 allows you to write off the entire cost of the vehicle in the year that it's placed in service, if the vehicle meets the requirements for Section 179. So that would be a gross loaded vehicle weight of 6,000 pounds or more, like a truck, basically, is what we're talking about in that case, or an SUV, and luxury vehicles, which is basically everything else, regardless of whether you think of it as a luxury vehicle or not. Those are going to be limited. You're not going to be able to write off the full value of that vehicle in the year that you buy it. There's also bonus depreciation, which is kind of like 179, but those weights, those don't matter. So you can write off up to 80% of the cost of your vehicle, still subject to those luxury auto limits, in the year that you purchase it. So there's some good, so then you're doing the math, like how long am I going to keep this vehicle? And let's just use the number I used before. Is a $60,000 deduction in 2024 worth giving up mileage for the rest of the time that I'm using that vehicle? So, am I going to get more benefit from the mileage than I will from the writing off of the vehicle? And the writing off of that vehicle, you are only allowed to write off the business use percentage. So if you use your new vehicle 20% of the time for personal use or 10% of the time for personal use, that write-off would be limited to the business use portion. Real estate professionals usually use their vehicles very, very, very high percentage for business use. I always suggest throwing the IRS a bone and at least going 90, 95. Don't try for 100. Show them that you're acknowledging that you have some personal use, unless you really, truly have one separate vehicle that you use only for personal stuff and one separate vehicle that you use only for business stuff. You do have to be careful, though, if you're regularly trading in your vehicles. It used to be, I want to say maybe up until about 6 to 8 years ago, that their vehicles, basically, as long as you traded it in for another vehicle, there was a like-kind exchange rule that applied to personal property, to vehicles. So you didn't have to recognize that gain. And now you do. So they no longer qualify for that exclusion. So when you trade in a rig, a vehicle for another one, the trade-in value, you're considered to have sold it for that much, and that's going to be income. So if you're buying a vehicle and trading it in a couple of years later, the benefit is going to diminish a bit because of that factor of having to pick up the income on the trade-in. So if you're going to do that, you're going to want to always make sure that the next vehicle you buy is more expensive, which, I mean, come on, it will be. But, you wouldn't want to go backwards because then you'll be picking up more income than you'll be recognizing as a deduction. So sometimes that can surprise people and trip them up. Probably you're all getting this next deduction already.
I have a quick question. I have a quick question for you on vehicles.
Yes.
Leasing versus buying. I know back a long time ago, 1999, when I bought my first house, our real estate agent drove a nice, pretty Cadillac. And she said she leases it and gets a new car every 2 years. So how does leasing a car play into that?
So leasing, if you are, that's a really good question. I'm glad you asked it. If you are going to be trading in your vehicle, trading up frequently, leasing is a less complicated way to go and probably is going to give you better tax result than buying, because you're going to get to deduct, the business. If you're spending, I don't know, $1,000 a month to lease a vehicle, so $12,000 a year, you will be able to write off. That would be considered like part of the actual cost of the vehicle. So the lease payment, the gas, the insurance, whatever costs you put into that vehicle while you're leasing it, those are probably going to add up to a pretty nice sum, even if you have to take a 10% haircut or something for the personal use. And you don't have to worry about the income pickup in the year that you trade because you never owned it in the first place, so you couldn't sell it. So that would probably garner you just as good, if not better, deductions over time, and it would be more simple on your tax return. I think then the real analysis would be just whether a lease versus a purchase makes sense, generally from a financial standpoint. And you just have to look at those transactions side by side. So you would skip the depreciation part in that case, and then you would just be looking at, you can still do mileage. So does mileage work better, or do the actual costs work better?
And I know,
does that make sense?
Yeah. And I know when we went to buy the house that we're in, had to kind of catch up on taxes. But I asked her to compare, because up until last year, I was still making payments on my car. So I had asked her to compare for me which would be better, actual versus mileage. And at that point, because my car payment was low enough, the mileage actually gave me more. And if you calculate, if you have one of I like Hurdler as a tracking app. And again, it tracks your business expenses. So if you are like me, and only have one account, you swipe right for business, swipe left for personal. So it does separate it out really easily for you. And I know there's other apps too, but then also tracks the mileage, and you can attribute that mileage to personal or business as well. You would be surprised if you got a regular car payment, you're not leasing, you'd be surprised at how much it costs you to drive from point A to point B versus how much you can write off. It's actually a lot the actual costs are a lot less than the 65.5 cents a mile. So sometimes it's kind of blown my mind when I've looked. It's like, it cost me $30 to drive here. Really? I don't think so.
Yeah.
So just kind of, something to keep in the back of your mind with that as well. Cause I know I
Yeah.
was really reluctant to do the mileage because, we did have another car to drive. I, at that time, was driving probably 80% my car for work. And she still did the math. And with depreciation and whatever, mileage was better. So
Yeah. Yeah. Well, yeah. I mean, the mileage is supposed to be, it's supposed to encompass the, use and depreciation and wear and tear that you're putting on your car. So in a roundabout way, you're kind of getting the depreciation through the mileage rate.
yeah.
And also, I mean, you got to value that, take into account the value of your time. I mean, who wants to keep receipts for every time they fill up their tank of gas and, have to try to keep account of everything throughout the whole year for the actual costs that you could layer on top of the depreciation to try to get back to that 65.5 cents or better. There is a non-quantifiable but real value there in hitting the easy button with the mileage. Yep. Okay, hopefully everybody is familiar with this second point on here because it's a really great deduction that's been it was a Trump era tax law that came in on the scene in 2018, I believe, and we'll have it through the end of 2024 or 2025. It's set to sunset. So it might go away. Hopefully they'll extend it. It's always a big ticket item when they're talking about tax packages on Capitol Hill. But it's the QBID is what we call it. It shows up on page 1 of your 1040. And basically it's a 20% deduction on the qualified business income that you have on your tax return. So if we go back to that $100,000 example from the S corporation versus sole proprietorship, if 100,000 was your net Schedule C income, you should be seeing a $20,000 deduction towards the bottom of page 1 of your 1040 for this qualified business income deduction. And then it is pretty straightforward, but it can get complicated when, let's say, maybe your spouse has a business or you have rental properties or there's other things going on your 1040 that could be generating qualified business income. If those items are resulting in losses, it can decrease the benefit of this deduction. So in those cases, it might not end up being quite as straightforward, but it's still a pretty nice deduction. You want to make sure that you're getting. Sometimes people miss the ability to claim self-employed health insurance for their entire family. Assuming they're pre-tax, you can include maybe, let's say, health insurance that's being paid through your or post-tax. That's a typo. You can't include anything that's like a tax-free fringe benefit that's flowing through, say, a spouse's W-2 or through their job, but you can include health insurance for your whole family, assuming that you're paying it. Our all meal write-off is going to be 100% for 2023 or back to 50%. I believe that the meals to restaurants are going to continue to be 100%, and then other meals are going to move, or I think in 2022 they might have already moved back to 50% for non-restaurant type meals, but for you guys it's probably going to be almost everything at 100%.
So Erin, I have a quick question too. So my husband and I are both self-employed, so we pay out of pocket for our own health insurance. So all of that is deductible.
Mm-hmm. Yep.
Okay.
Yep.
Okay.
Absolutely.
So what is considered a non-restaurant meal? I mean, when we eat out with clients and things like that, I'm like, what? I mean, I guess it would be if I had a cocktail party at my house or a client appreciation dinner at my house and I was preparing the food versus hiring a caterer to do it. Is that what we're talking about?
Yeah, right. Or, I mean, even maybe with the caterer example, maybe you had like, maybe there was a, I don't know. Yeah. In your guys' business, it's hard to imagine what that would look like. I was going to say, a catered event where you brought clients in, to the agency or something like that, and just had like a client appreciation party or gathering. Right. That would not be considered to be a restaurant, okay. But taking them out to lunch to, I don't know, Anthony's, which just probably means nothing to most of the people here on this call. That would be considered to be, yeah. So most of the time what you guys are seeing is going to be a restaurant.
Okay. So then I presume that 50%, and this is something that I know would apply to everybody. I presume that 50% would be like for food we also purchase for open houses.
Mm-hmm.
Because it's not in a restaurant. Okay.
Yeah. Unless you can somehow kind of cobble it all together for some sort of promotional type cost. This is the cost of putting on an event that was intended to be for promotional purposes. Maybe you could take a different position. Mm-hmm.
Yeah, and then Lisa just wrote as marketing, and that's, I mean, essentially an open house is an event. It's a marketing event to get people to come look at a house. Yep. Yeah, and Lisa said open house could be considered marketing. So yeah, I get that.
Yeah.
That's my CPA to lump it under too.
Mm-hmm. Yeah. Yep. Yeah, just kind of point back to the intention of why you're doing the thing that you're doing, and, of course it's to help the client sell their house, but, it's also a good portion of marketing as well. So, and you're putting time and effort into it. Also kind of along those same lines, if you're making charitable contributions, I don't know, let's say you're supporting, the Little League or the YMCA, or, there's you're supporting the local high school and your name as a realtor, your agency shows up, and somehow that's, giving you PR out there, it's getting your name out there. Treat that as marketing and advertising. Don't treat that as a charitable deduction, because it'll reduce that self-employment tax on your Schedule C.
Yeah. And I mean, it's a sponsorship generally when we do something like that. So there is some sort of advertising that goes along with it.
Yep.
Okay.
Yep.
Cool. So Lisa, I think that answers your questions. You said, could it be a marketing expense as well? Okay. Home office deductions. Anybody that is with eXp Realty absolutely has a home office, but any real estate agent in general has a home office. So
Yep. Just remember your computer, your furniture in that office, the things that you do in that space, 100%, deduct those at 100%. Don't take the haircut for the square footage. So there's just some things that you can look through, make sure you're carving out those direct expenses versus indirect being, a portion of your utilities, a portion of your mortgage interest, so on and so forth. Yep. Okay. We're almost there, guys. Because this is the last slide I have, and then we can just do open questions, or if there's anything that you were really hoping that I would have hit on that I didn't, I can try to do that on the fly. I have been telling everybody this year, regardless of their industry. It used to be, even just a year ago, I would have conversations with people, and it would go something along the lines of, I don't want to give the IRS my money any sooner than I have to. And I'm not going to do that because I can earn more money on those dollars while it's in my bank or invested or whatever. That was true for quite a few years, but it's beginning to get to the point where it's not quite so true anymore. So just so you know, the IRS is really, really, really ratcheting up on the estimated tax penalties and the rates of penalties that are applying to underpayments. Just in the course of 24 months, it's more than doubled, and it's slated to continue to rise. And it's about the highest that it's ever been right now at 8% is the penalty you're paying for not paying the IRS their tax over the course of the year, but waiting until your tax return is due. So just a heads up on that. It's like happening in the background, and obviously they're not really telling people too loudly about it. So just a heads up. And then I am happy to field any questions if you guys have time for that, or if there's things that we didn't get to that you want me to touch on.